we look at our portfolio, if we didn't put any new trades on today, and you notice with my portfolio, I don't do a lot of trades. I'm waiting for the stock to drop in half, or I'm waiting for it to double. And I'm either taking profits or I'm averaging down. And you can see I'm really small. And look how small I am. Combine these three stocks together, I'm already down $620. Then I got to add in my EuroNav dividends. I got $60 in dividends, but then they took $20 out for tax. Left me with $40. And then on my front line, I made $100 in front line, but then I was short stock on the dividend. And so yesterday they came in and took $70 from me. I don't suppose they're going to give me a tax benefit. I suppose not, right? Going to give me a tax liability when I collect a dividend, and then I don't get a tax benefit when I'm short the dividend. You got to love this government. All right, so this is where we're at with these positions. In the comments section, there was a comment about trying to get their head around the naked put that we did in DHT and how that was different from the 100 shares of stock. So today what we're going to do is go into detail around why we're getting naked on the 6 put versus buying the shares. I want to make sure everyone really understands the dynamic around this so that you can appreciate how you can use these tools to help you with your investment. If you do remember, NAT, we sold the 5 put for $1.05. The stock's at $4.30. We now own the stock at $5 because that was the strike price. But there's $1.05 in premium we collected. So it's showing us down $135. That's across all the trades we've done in NAT. We've done quite a few in there since we started. But what you can see is at $4.30, if all we did was sell a naked put in NAT, we'd be making a profit right now. Because at $4.30, we would be up $35 in there. So imagine that. Instead of being down $135, I could have been up, have a profit already in NAT. So that's how you can really benefit from shorting puts as a part of your strategy. So let's hop over and go into why we would want to sell a naked put versus owning 100 shares in DHT. Now, if we want to, we could take a quick look at the chart of DHT. We can see here that I've outlined with that naked put, my cost basis is going to be $4.85 for DHT. And here's the shares that I bought. So you can already see there's a difference of $104 between these two. So this is really going to help me bring my average cost down. Very little capital required to put this trade on. And if the stock goes back up, then obviously if it gets back above 6, which is right here, then I got to keep all that premium, right? So it's a good step in the right direction. It's just another tool in the toolbox. So let's go review what it means and what the benefits are of doing a naked put in DHT. Ready to be blown away. Now, to make this easy to understand, let's start with the basics. We bought 100 shares of DHT. So let's understand the payoff risk graph for our 100 shares of stock. There's the stock price along the bottom and our profits along the left. So we bought the stock at $5.30. So let's think about where our break even is for the stock. We'll break even at $5.30. And then when we think about our profit, you'll see the arrows there. When the stock price goes up, our profits go up. And you can draw a line right down the middle. Can you see how that works? When the stock price goes up to 8, then we're making almost $3. Unlimited profits to the upside. And then the same thing to the downside. We have unlimited losses below. And we'll come back to that at the end to understand it. So who wants to get naked? A naked put option. Now, what is a put? The option is basically agreeing to sell 100 shares at a specific price by a specific date. That's it. This is like you becoming an insurance agent and you're selling a policy to someone and you're collecting the premium up front. So who is the naked put option? It's actually just the seller of a put. You either buy a put or you sell a put. And if you're a seller, they say you've basically sold a naked put. Why? The contract is called naked because the seller is not covered by being short stock. So you're exposed to unlimited risk to the downside. That's why you're called a naked put. How can I get one of these naked puts? You can just do what I did. You can sell a naked put on DHT. I put an offer in the market at $1.15 for the 6 strike with 2 months to expiry and left a limit order, and then someone ended up coming in and buying it from me for $1.15. So you can trade options just like you can trade stocks. Now the buyer who bought that from me, they have to pay me money up front, just like an insurance. Hang on, now we're like an insurance agent collecting premiums. I think we just found a new business. So what is a fair price for my naked put option? Well, there's 3 factors to think about when you're writing an insurance policy. There's time to expiry. How long do you give them to decide if they want to sell their shares? There's the strike price compared to where the stock price is trading. And then there's the market expected volatility. Are there any expected events to worry about? Now, when is the best time to sell insurance? The best time to sell insurance is when the ship is on fire and the insurance cost is going to go right through the roof. That's when you really want to think about selling premium. So what happens at expiry of this naked put? Well, the buyer's got to make a decision. They're either going to sell you their stock or the contract policy is going to terminate, and then you keep all the premiums that were paid to you up front. That's how it works. Just like insuring your house. If you don't use it by the end of the year, then it disappears. They get to keep your premiums. So now, why would we sell insurance via a naked put option versus just buying 100 shares? We've done both. Well, when we sell our one put option, we collected $115, and then when we bought our 100 shares of DHT, we had to pay money for the shares. So the option actually gives us a credit balance, and the stock, when we buy it, we actually have to pay money out. When do I lock in profits on this naked put option? Well, the options trade on an exchange just like stocks. So you can buy and sell at any time. There's always a bid and ask price. So you actually don't even have to wait till expiry to take profits if you want to get out earlier. Now, what are the risks of a naked put option? The order form, when you submit it, it says you may have assignment risk. What does this mean? It means there's a possibility that the buyer of that put might assign 100 shares to you, and the broker might send you an alert and say, hey, I just assigned you 100 shares in your stock account, and then I'm going to want to take money from you. So you got to make sure you have cash on hand in case you get assigned those shares. So now let's try to visualize what the payoff risk is for this option. This is really important to understand this. This will make it so easy for you. First, let's take a look at the risk profile that we did when we first started on the stock. What was the stock payoff risk profile look like? Remember, it's a straight line. As the stock goes up, you make money. If the stock goes down, you lose money. And your break even was $5.30. Now, when we do the put, because we collected $1.15, our break even is $4.85. It's actually below that of buying the stock. That's our break even. And then, of course, if the stock goes up to $6, then we collect max profit. We collect $115. Now, if it continues to go up, we can't make any more than that. We're capped. That's our max, right? But we still have unlimited losses below $4.85, just like a stock. Now, when you look at this profit risk profile, does this look familiar to you? What does this remind you of? Is there another option contract that looks just like that? Is it a covered or a naked call? Think about it and leave comments down below if you think you know which one it is. So how do we compare the payoff risk for these two positions? We own 100 shares of stock and we sold a naked put. So let's think through our max profit for each of these positions. So for the stock, we have unlimited upside. As the stock goes up, we keep making more money. On the option, we're capped. We can't make more than $115. The break even is actually lower on the option than it is on the stock. And both of them have unlimited downside. So can you see the difference between the two? You know, there is no free lunch, right? The break even is 45 cents lower on the option. And by the way, insurance agents love these kind of contracts. Collect premium up front, properly assess the risk of something happening. So there you go. That's the analysis of these two strategies. Same way an insurance agent sells premium, collecting that cash up front and then being able to manage the risk if something unexpected happens. So you have to make sure you have the cash in your account to be able to take delivery of the shares if something unexpected happens. So I hope this helps you understand the difference between a naked put and buying stock, and I hope you can think about adding this really interesting strategy to your toolbox. When the ship is on fire, instead of buying stock, sometimes you're better off selling them some insurance premium. All right, good luck.